Hi, everyone. Hope everybody is doing well. My name is Carlos Lorenzo. I'm with American Caribbean Real Estate. I'm a real estate agent located in the Florida Keys. And today I have Robert Kline from US Bank. He's one of my lenders. I've asked him to chime in with me today, and I wanted to do a little Q&A with him because last week, as most of you might know, rates went up substantially, and there is a lot of talk about rates going up this year. The majority of my clientele is reaching out to me, and that's literally the number one question. Hey, Carlos, what's going on with interest rates? How high are they going to go? Are they going to come back down anytime soon? What's to be expected? And since that's not my area of expertise, I brought on Robert Kline, once again, US Bank. He's one of the lenders that I refer a lot of my business to. And by the way, thank you so much for taking the time to educate us all and answer some of these very important questions.
My pleasure. My pleasure. So I've been in the banking industry for over 40 years, initially as an investment banker, a CEO of a small banking company in New York. And I've been in the mortgage business as a mortgage banker since 2001. So over 20 years of mortgage experience.
I like to let my clientele know, because what happens is a lot of times clients, they have a realtor, and some realtors don't have certain, experience and background, and some are just, real estate agents. In my particular case, as you know, I do have a background in mortgages as well. I used to be a loan officer, just like you. I worked at Regions Bank. So the time that the day that you and I met and had a conversation, I knew immediately that I wanted to work together with you because you had that corporate structure. One of the parts of your background being the investment banking side. In the market that we're in, I deal with a lot of, self-employed borrowers and very sophisticated tax returns and stuff. And I have watched what you've been able to do and how you've been able to understand those documents, where some other lenders might have a hard time with it. So I just, I think it speaks to the value that that I'm trying to bring to my clientele. So,
well, as you know, I've been working with you and your colleagues at American Caribbean for over 5 years now, and it's been a wonderful experience. But I'm certainly known as the guy who you go to when you have a hard loan and a difficult borrower to get the loan closed. And that's my job, to make sure that loans close and that they close on time.
Yep. And that you've done. You've definitely proved that to me.
Thank you.
So today we've got, as you know, we've got a lot of questions and a lot of nervous clientele right now with what's going on. So wanted to see if you can take a little time and just, speak and give us a little bit of feedback as to explaining to our clientele as to why is it that rates are rising at the time.
I'll be happy to. So historically, there are a lot of reasons that interest rates increase. But in this case, it's very, very simple. And if there was one word that can define why interest rates are currently going up, that word would be inflation. The Federal Reserve Bank in Washington is looking to slow down demand. And one of the ways that they do that is to increase the cost of money. And if they increase the cost of money, they think people will slow down their buying habits, reduce demand, and allow supply that really got affected during COVID and COVID-19 pandemic to catch up. Supply chains are getting better. Things are moving better through imports, but we're not there yet. There's still a lot of material and goods shortages, including chips, computer chips that are used for pretty much everything now. As you know, not only are home prices going up, but car prices are going up, television prices are going up, everything is going up. And the reason prices are going up is that people are demanding that they get these goods now. And the only way that the federal government can intervene would be to increase rates and the cost of money to buy these goods.
what would you say that and now, so the Feds are talking about several rate increases. What is it that you're expecting to see from the Fed, in the next 12 months?
Well, it's not so much what I'm expecting, but I try to keep my thumb on the consensus of opinion that's going on in the marketplace. So if you would have asked me this question 3 months ago, year end, sometime in December, I probably would have said, and the consensus of opinion was that there would be 3 to 5 rate increases in 2022. And those 3 to 5 rate increases at 1/4 of a point per rate increase by the Fed was really the thought process 90 days ago. Well, as inflation has gotten worse over the last 90 days, the consensus of opinion has changed. And instead of 3 to 5, we're talking about 5 to 7 rate increases in 2022. And we're also talking about greater rate increases each time, some of them to be greater than 1/4 of a point. And they do them in point increments. And they're talking about a couple of them being half-point increments. So that means that rates will increase significantly in 2022.
6 months ago, we were closing some deals at like 2 point, in the mid twos. Now I'm hearing in the mid to high threes somewhere. We're roughly right now. If a client today were to call you today, what would today's conventional regular loan, someone with good credit, giving 20% down, good regular going rate today?
Mortgage rates are not dictated 100% by what the Fed does. What the Fed does is they give the traders guidance. And what the mortgage rates are pretty much dictated by, and you can follow what's going on in mortgage rates, is if you follow the 10-year Treasury. And the 10-year Treasury is available on any website. You can Google 10-year Treasury yield. I follow it on marketwatch.com, but there are any number of services that provide what the 10-year Treasury is doing on a minute-to-minute basis. And today, for example, the 10-year Treasury went up 15 basis points. Now, 12.5 basis points is an eighth. But just today alone, the 10-year Treasury went up 15 basis points from 214 to 229, so 2.14 to 2.29. And to give you an example, just 2 weeks ago, on March 4th, the 10-year Treasury was at 1.73. Today, it's at 2.29. That's 56 basis points. That is over 0.5 point, as 50 basis points is equal to 0.5 point. So interest rates have gone up more than 5/8 of a point. And the reason they've gone up more than 5/8, so 5/8 is 62.5 basis points. The reason they've gone up more is the banks sort of lead and try to predict where rates are going to be tomorrow. So they'll raise them a little bit more than where these guidelines are telling us they should be. All banks are doing this. Now, U.S. Bank is very competitive in the rate market. We're a national lender. We lend in all 50 states, but we are competitive and we're keeping rates as low as possible. But the cost of money is increasing to us, and we pass that cost along to the consumer. Okay. And that's what 2022 is bringing us. And again, things could change as the demand begins to slow down. The Fed can also slow down their increase in interest rates. But based upon everything that we're hearing today, that's a reasonable guesstimate of where rates will be within the next 12 months. But as I mentioned a few minutes ago, the Fed already changed their opinion, and the consensus already changed their opinion in the last 90 days to make it worse. 90 days from now, they can also change their opinion. And if inflation shows signs of slowing down, then we may not have the number of interest rates that they're saying we're going to have, and we may not reach the numbers that I just mentioned.
Thank you so much. I mean, incredible explanation as to how we got to there, how we're getting to these rates, and how rates, increase. Over the last few days, I've been getting this exact question. You know, as you know, I'm located in the Florida Keys. The majority, we do have a lot of primary residents. Hey, I'm a primary resident. I live here. But
Lucky you.
yes, thank you. I am blessed. But a large portion of our sales are second homes and investment properties. How would you say, and what do you see? Do you see it affecting that market right now? I mean, how do you see this work playing
So the
out?
second home and investment market are the loans in those markets are priced differently. So conforming loans in the second home market have been drastically increased by the major conforming lenders who are Freddie Mac and Fannie Mae. And Freddie Mac and Fannie Mae have basically decided to turn off the spigot as far as lending money on second homes. And the reason they made that decision, and they made that decision in early 2021, they opened it for a few months towards the end of 2021, but closed it again in January of 2022. And the reason they are doing that is because many of the conforming loans, a greater percentage than they're comfortable with, are being used for second homes and investment properties. Normally, the number of primary residents that Fannie and Freddie lend to is about 95% of their loans. It's dropped below to 91% of all loans, and they don't want to lend that much money on second homes, especially on second homes. So where it used to be that primary residence and second home conforming loans, the interest rate was basically the same. It's not that way anymore. So for conforming, we're pretty much at the whims of Freddie and Fannie at the present time, and second home interest rates for a conforming loan are expensive. However, U.S. Bank, we are a portfolio lender. So we lend our money on second homes. And one of the things that we are very much in the market to do is lend our money on jumbo loans to second home buyers. And one of the great things about U.S. Bank is that our interest rates are exactly the same for a second home as they are for a primary residence. But this product is a jumbo product only. So the jumbo conforming limit in most parts of the country is a loan amount greater than $647,200. So if you're going to buy a property and we can get your loan amount over $647,200, we can give you a better interest rate for a second home than we can for a conforming loan, a significantly better interest rate, which is very strange. But Fannie and Freddie being the primary lenders on conforming, we have to basically do what they tell us to do. But jumbo, it's our money, and we are in the market of lending money to qualified buyers for second homes. And second home means that they're going to use the property for their enjoyment. Now, investment properties are a little bit different than second homes. And what's happening in the investment property market is that there's always been a pricing adjustment for investment properties because that the matrix says and the algorithm says that if somebody is going to have financial hardship, the first property they're going to let go is the investment property. So the investment property rates have always been higher and they continue to be higher. So we think that at U.S. Bank, if you're, and in your marketplace, especially in your marketplace where most properties fit into the jumbo loan category, we have a great product to offer everybody. So we encourage everyone to buy second homes, and especially in your marketplace. And our rates are better, I believe, than anybody else's in the country because most lenders are not offering second home loans at the same rate as primary residence loans in a jumbo market.
As you know, I've had several very, very high net worth individuals. These are clients that have their banking relationships, and I usually will ask my buyer and client, hey, do you have a good lender? I have a really good lender I can refer you to. And usually the first response is, no, thank you. I've got my banker. He takes care of everything for me. And I'm usually very respectful of that stuff. So I leave that to the client. But usually after some time, after I build a rapport with them, I always remind them, hey, you sure you don't want to shop it? You don't want to, get a second opinion? And I've got to say that every single client I've sent to you, you've blown them out of the water. And then the only client that I remember that decided to go with another bank for only because of their relationship literally told me that he regretted it badly that he chose them because it was such an awful experience. I'm not going to say the name of the bank or anything, but it was an awful experience. And I've got to say, in your situation, you have closed jumbo loans for people that are self-employed, which this is very complicated type of loans, and you've closed them within 30 days. So I just gotta throw that out there. So big props to you.
Thank you.
I mean, I was going to ask, at the end of the day, why Robert Kline, why US Bank? I think you just answered pretty much most of that. So what I'd like to do is ask you, how can someone reach you?
Also add one thing, if I may.
Yes.
So why Robert? Okay. Yeah, I answered why US Bank. Let me answer why Robert Kline for a second. We touched on it. And the answer is that I'm client-centric. It's always about the client. It's always about customer service. It's always about making sure the client has as good an experience as we can possibly offer them, getting them the lowest rate and making the process, which is a difficult process, as smooth as possible. I don't advertise. I've never advertised for business. I don't have people in the back room cold calling for business. My business is 100% referral based. And over the last 21 plus years, I've built a client base that I'm very proud of, and they refer me business, and they refer me an enormous amount of business, and I'm very satisfied with what I've done through my entire career. As a matter of fact, the loan we just closed last month, new client that you referred to me, he's already referred me another client, and we're doing a loan for him here for his referral here in Palm Beach County. So it's very exciting when you're able to satisfy clients and they continue to refer business to you. And that's where I generate all my business. And that's why clients are the most important part of the loan process. And I focus on them, I take care of them, and I stay involved in every loan that I do with them.
I remember when you came down and took us out for dinner, one of my clients actually gave you his home. And let's say it was not a shabby home. It was a very, very nice home for you to stay there because he was so appreciative of how well you took care of him. So, so I
a beautiful home it was. Beautiful home. You sold it.
Yes, sir. It was. So, Robert, how can someone contact you? What's your phone number?
Well, thank you for asking. It's 561-866-5566. That's my cell phone. I will answer it any time I'm awake. So I'll do everything I can to get right back to you. If I don't answer it, it means I'm on another call with someone else. But you will always hear back from me within 24 hours of you calling me. That's my goal each and every time. West Bank, I'm out of the Delray Beach office in Delray Beach, Florida. And I look forward to working with you and your referrals and anyone else out there in the not too distant future.
I'm going to go ahead and put your information also down below, all your contact information. Guys, I know this was a lengthy video, but we felt that we really wanted to get a lot of information out. This is a lot of information a lot of people are always asking about. And there's, it's very hard to find someone that can really explain it in layman terms and really understands everything. So that's why I chose to call you and ask you to do this for me. So I really appreciate that.
Let me touch on one more thing, if I may. How did rising interest rates affect the home buyer? And whether it's a primary residence or a second home or investment property, what happens when interest rates rise is that the person's buying power, the homeowner or the potential homeowner's buying power gets decreased. And what's happened so dramatically over the last 2+ weeks is that if we take a loan amount of $100,000, 2.5 weeks ago, the buying power per $100,000 of principal and interest was a little bit over $400 a month. So if I locked in a rate 2.5 weeks ago, my buyer per $100,000 would have cost them about $420 per month. Today, 2.5 weeks later, that same $100,000 buys a client. It costs the client $500 per month. That's a huge difference.
That's massive.
If you think about it, that's a 20% increase in what it costs the client to buy the same house. And that's a 20% decrease of what a client can afford to buy. And especially is difficult for a primary residence and first-time home buyers that are on a budget. And when I qualify somebody, first question I ask them is, how much do they want to spend? What do they want their housing budget to be? And that gives me a guidance of what they can afford. So when a budget, if somebody has a housing budget of $2,000 a month and $500, it costs them $500 per $100,000 today, and $100 more than it did 2.5 weeks ago, they've gone from a $500,000 loan to a $400,000 loan for the same buying power. And that affects the price that they can afford to pay for the house. It's nothing more dramatic than that.
Yeah. That's very significant. Very significant. What happens, what I'm seeing is it's not, or at least I have not seen it affect our market in the Keys yet, because again, we have a very large discretionary income market. We have a market where this market has also been borrowing on some of this these properties because money is cheap. So I'm very interested to see in the next few months how my clientele starts to react, and am I going to see them buying more cash because they do have that cash, or are they still going to try to leverage out, or are they going to start to hold now?
Well, one thing I found through the years that people who are buying second homes have disposable income to spend. Obviously, it's not a necessity, it's a luxury. So those people can afford to buy a second home, and they can afford to compensate for the increase in rates by putting down a larger down